Greetings from OneMedRadio. Today I'm with Ryan Starks, partner and practice leader within BDO's Technology and Life Sciences Industry Group. Today we will be discussing the state of life sciences investment and how the Jobs Act, coupled with changing regulation, has fostered growth in the sector. Ryan Starks will be moderating a panel exploring the impact of the Jobs Act at the upcoming OneMed Forum, June 26th and 27th at the Metropolitan Club in New York City. So thank you for joining us, Ryan.
Thanks, Matt.
I want to start with an overview of the sector. So how healthy has investment in the space been this past year?
Interestingly, it's been pretty healthy overall. Saw a statistic, there's 14 biotechs that have gone public in the first half of 2013, which is actually the sector's best start since 2007. It seems overall to be progressing well this year. I think there has been some benefits from the Jobs Act overall with respect to emerging growth companies taking advantage of some of the reduced disclosure and filing requirements. I think what we're seeing is the benefits of that coming through and an acceptance in the marketplace of companies leveraging these regulations.
You and I touched base around the same time last year, so compare market activity this year and investment to what was going on last year.
Well, again, I think overall we're seeing continued focus in the industry and hopeful that the second half of the year will continue as strong as the first half has appeared to be.
So which subsectors are seeing the most growth?
Yeah, it's interesting. We're seeing a real uptick with healthcare IT companies, and there's somewhat of obviously a crossover between technology and life science entities with these healthcare IT companies. A lot of them are developing software or related technologies for healthcare providers. A lot of that expansion has been generated from the High-Tech Act, which provided a lot of incentives for companies to upgrade their infrastructures. So we're seeing a fair amount of activity both from M&A in this space, whether it's company to company or even from private equity investments into the space. So it's been a pretty growing market in the first half and even through 2012 into the first half of 2013.
Can you point to any particular case studies?
We actually published a report, our BDO Capital Markets, in the first quarter of 2013 that touched on some of these aspects, where we did some pretty extensive research in the type of companies in the space. So overall, we're seeing a good level of M&A activity across the marketplace.
So let's shift gears a little bit. Are we experiencing a patent cliff?
A couple of years ago, the patent cliffs were definitely the forefront for the pharmaceutical companies. The larger story was Lipitor, Pfizer's Lipitor, coming off patent. It was one of the original big blockbuster drugs. It's definitely impacted the entire industry, all of the various drugs that have faced patent cliffs. You're still going to have it going forward. We've seen the generic market increase to take advantage of those patent cliffs, the opportunities that it presents for generic pharmaceutical companies. We're also seeing a growing aspect with respect to biosimilars and companies moving into creating what are effectively generic brands of biotech drugs. So we're seeing just a continued development overall of the underlying technology in the space. I think you'll always have patent challenges inevitably, but the companies seem to do a good job of evolving and being able to manage through those situations.
And in May, you released a report identifying top risks for life sciences companies, particularly highlighting regulatory risks. What trends have you noticed here?
Yeah, this was a study that we conducted as an initial analysis for the past year, and we're happy with the results. We took companies based out of the NASDAQ Biotech Index and looked at the risk factors that they had disclosed in their 2012 year-end 10K filings. And in evaluating the types of issues that these companies were considering risks to their business. So not surprisingly for life science companies, regulatory matters were at the top of the list. And that is impacting all companies are impacted by regulatory requirements, but clearly for life science companies, with the nature of the underlying products, the additional oversight by the FDA, clearly we weren't surprised to see this as the top item selected.
So do you believe we're approaching a period of looser FDA mandates, or is the FDA actually tightening its belt?
I think what the FDA is doing is making sure that the products ultimately that consumers are using are quality products, and newer products that are being developed are providing a real benefit, that a follow-on product has some distinction to it. And ultimately, I think that provides benefit to the consumers who are relying on them to help. That's the interesting part of all of the companies in this space. Their products are really geared towards helping individuals work through whatever challenges they may be having from a health care perspective.
Brian, let's turn to the Jobs Act. What are the most important components of this legislation for emerging growth companies in this space?
You've really got three components to the Jobs Act. We've got the IPO on-ramp, which is really geared towards the emerging growth companies. The new regulations have defined those as companies with less than $1 billion of revenue. You've then got two proposed changes, one related to crowdfunding and one related to what are called mini public offerings, or proposed changes to Regulation A and Regulation D of the Securities Act. So as we look at the impact, we're seeing the regulations that are affecting EGCs having a fairly positive impact and gaining acceptance in the marketplace. Some of the changes permit companies to file registration statements, silently, so that they can vet issues with the SEC prior to having those items released publicly, as the case in some of the technology companies experienced a few years ago. Groupon, for example, had some accounting challenges from the SEC and had to restate during that registration process, which is never good PR. So this is going to help companies vet various aspects of their filings and the process overall, without having it in the public arena until they're ready. So that's a positive. There's reduced disclosure requirements for EGC companies, meaning when you file a registration statement, you only need 2 years of audited financial statements. Historically, it was 3. There's also reduced compensation and discussion analysis requirements for EGC companies. So what you're doing is effectively lowering the accounting and legal costs for these companies to go through the going public process.
And lastly, you touched on crowdfunding, and I know there's been a lot of active discussion about it, particularly at the previous OneMed forums. So in your opinion, though, is crowdfunding actually feasible in the healthcare and life sciences space?
Well, it's interesting, because I think the changes that they're proposing for crowdfunding and putting some structure around issuing equity instruments through a crowdfunding vehicle, which is different than a lot of the crowdfunding sites that are out there now, which are more from a donation perspective. The question really is, what happens after the crowdfunding raise? Now you're a company, you've done this transaction, you have an additional number of shareholders, some of which may or may not be as sophisticated as, or an accredited investor perhaps, that you would through other processes. And is that going to assist or perhaps limit the future ability of an entity to raise financing, primarily from the thought process of now a larger investor wants to come in, do they really want to deal with all these additional shareholders who may have their own interests rather than what the company is striving to achieve? I think the proposed changes to Reg A may mitigate the need for crowdfunding, perhaps, because if you can raise the limit for offerings from a $5 million to a $50 million, that's a pretty sizable change, and that'll facilitate a large number of companies looking to do that, private financing essentially without having to go through this crowdfunding approach. You may wind up in a similar spot, but I think it's a more understood approach overall. So I think there's a lot of positive feedback that you're seeing with the proposed changes to Reg A, but ultimately the SEC hasn't approved these changes yet, so we're still kind of in a wait-and-see mode.
That was Ryan Starks, partner and practice leader within BDO's Technology and Life Sciences Industry Group. Ryan will be moderating the panel exploring the impact of the Jobs Act at the upcoming OneMed Forum, June 26th and June 27th. With OneMed Radio, this is Matthew Margolis, signing off.